I'm giving you a challenge. How would you decide between overpaying your mortgage or investing your money? A wrong choice now could cost you more than just interest payments. It could impact your entire financial future. This is a decision that many homeowners face, and the stakes are higher than most people realize. To help you see the real-world impact, we'll follow two homeowners, Mark and Sam, over the next 15 years to see which path wins out. By the end of this video, you'll know exactly how to tackle this financial dilemma with confidence. Stick around until the end to find out which strategy might fit your goals, and let me know in the comments which path you're leaning toward. Let's start by looking at what happens when someone goes all in on paying off their mortgage early. Mortgage-focused Mark, the guaranteed path to debt freedom. Mark's journey starts with a clear goal: pay off his mortgage as fast as possible and cut down on interest. He's motivated by the idea of being debt-free and values the certainty that comes with each extra payment. Every spare dollar goes toward his loan, and he likes seeing his progress add up in a way that's easy to track. For Mark, the appeal is simple. He doesn't want to worry about monthly payments hanging over his head, and he's willing to pass up the unpredictability of the stock market for the peace of mind that comes from guaranteed debt reduction. Let's look at how Mark's approach works in practice. Overpaying on a mortgage means you're attacking the principal directly, which lowers the total interest you'll owe. For example, assuming a typical 3% fixed rate today on a $250,000 30-year loan, the standard monthly payment is about $1,050. Mark decides to add an extra $400 each month. That extra payment chips away at the principal, so less interest accumulates on the remaining balance. Over time, this makes a big difference. Not only does Mark save tens of thousands in interest, but he also finishes paying off his mortgage much sooner. By focusing on this strategy, Mark's timeline speeds up dramatically. Adding $400 a month to the payment on a $250,000 loan at 3% cuts the loan term by about 12 to 13 years based on standard amortization schedules. His first big milestone comes at year 5, when his mortgage balance is already far lower than most homeowners in the same position. By year 10, his interest savings reach approximately $25,000 according to standard amortization tables for a 3% loan. By the end of year 15, Mark is completely mortgage-free, 15 years ahead of schedule. He now owns his home outright, and the financial stress of monthly payments is gone. The appeal is obvious. His progress is steady and predictable, and every payment brings him closer to full ownership. But there are trade-offs to consider. One limitation is that paying off your mortgage early doesn't always offer a tax advantage. While mortgage interest can be tax-deductible, the benefit only applies if you itemize deductions. And with the standard deduction higher than ever, many homeowners don't see any extra tax break from their mortgage interest, according to recent IRS guidelines. Another key point is that every extra dollar Mark puts into his mortgage is a dollar that doesn't have a chance to grow elsewhere. Historically, the stock market has averaged returns of around 7% per year, much higher than the 3% interest he's saving. By focusing only on debt payoff, Mark avoids market risks, but he also misses out on potential investment gains. There's also the question of flexibility. Mark's wealth is mostly locked up in home equity. If he faces an emergency or wants to take advantage of an opportunity, accessing that money isn't easy. He'd have to refinance, take out a loan, or sell the house, all of which take time and may involve extra costs. So, after 15 years, Mark is debt-free and owns a valuable asset, but with most of his money tied up in his home and little invested elsewhere, his financial flexibility is limited. He's achieved the security he wanted, but at the cost of missing out on other opportunities. This leaves a big question. Is there a smarter way to use extra cash for long-term growth? Investment savvy Sam, betting on the power of the market. Sam takes a different approach. Instead of putting extra money toward his mortgage, he invests that cash each month in a diversified portfolio of stocks and bonds. He believes that over time, the returns from the market will outpace the interest he pays on his loan. For Sam, the chance to grow his wealth is more appealing than eliminating debt quickly. Let's look at how Sam's plan plays out. He's got the same mortgage as Mark, $1,050 a month on a $250,000 loan at a 3% fixed rate. Please like and subscribe if you like the videos and share with your friends and colleagues. But rather than overpaying his mortgage, Sam puts an extra $400 each month into investments. He chooses a portfolio with an average annual return of 7%, compounding monthly. Of course, that 7% isn't guaranteed. Sam endures volatile years but trusts historical averages around 7%. He knows there will be times when his investments lose value, but he's focused on the long-term trend. After 5 years, Sam's investment account has grown to about $29,000. By year 10, his consistent contributions and compounding returns have built the balance to nearly $68,000. At the 15-year mark, his portfolio is worth around $122,000. These numbers assume steady monthly contributions and a 7% annual return compounded monthly. While Sam's mortgage balance is higher than Mark's at every stage, his growing investments give him a different kind of financial security. One of the main reasons Sam feels comfortable with this strategy is the math behind it. Over the past 90 years, the S&P 500 has returned roughly 10% annually before inflation and around 7% after inflation, according to historical market data. With his mortgage rate at 3%, Sam believes the odds are in his favor if he invests instead of paying down low-interest debt. He's leveraging the difference between what he pays in interest and what he hopes to earn through investing. Sam also takes advantage of tax-advantaged accounts. By using a Roth IRA, he benefits from tax-free growth and tax-free withdrawals in retirement as long as he follows IRS rules. If he uses a 401k or traditional IRA, his contributions can grow tax-deferred, meaning he pays taxes later when he withdraws the money. This tax efficiency can help his investments grow faster than if he put extra money toward his mortgage, where the tax benefit from interest is limited and usually decreases over time. Sam's approach gives him flexibility. If he needs cash for an emergency or wants to seize a new opportunity, he can access his investment account more easily than if his wealth were tied up in home equity. Still, he knows there's risk involved. The market can be unpredictable, and seeing his portfolio drop during downturns isn't easy, but Sam is willing to accept this uncertainty for the potential of higher long-term rewards. After 15 years, Sam's financial picture looks very different from Mark's. He still has a significant mortgage balance, but his 6-figure investment account offers liquidity and choices. The trade-off is clear. Sam has prioritized growth and flexibility, while Mark focused on security and debt freedom. Each strategy comes with its own set of strengths and vulnerabilities, which become even clearer when you compare their outcomes side by side. The final showdown, Mark versus Sam's financial outcomes. Now let's see how things look after 15 years for both Mark and Sam. Mark has reached a major milestone. His mortgage is completely paid off. He owns his home outright and no longer has to budget for monthly payments or interest. Thanks to his steady overpayments, he's saved around $35,000 in interest. But while Mark's home is fully his, most of his wealth is locked in the property itself. This means he has little in liquid savings, so if an unexpected expense comes up, accessing cash could be slow or complicated. Sam's outcome is different. He never overpaid the mortgage, so after 15 years of making minimum payments at a 3% rate, he has an estimated balance of about $150,000 remaining, though the exact number would depend on his loan's amortization schedule. On the other hand, his investment portfolio has grown to over $120,000 thanks to consistent $400 monthly contributions and compounding returns. The key advantage for Sam is liquidity. If he needs money for an emergency, a big opportunity, or just wants flexibility, he can tap into his portfolio right away. That's a level of access Mark doesn't have since his wealth is tied up in his home's equity. Of course, Sam's journey hasn't been stress-free. Over 15 years, he's experienced both market gains and losses. Watching his investments drop in value during downturns can be tough, even if he trusts the historical average return. Mark, meanwhile, has enjoyed the peace of mind that comes from knowing every extra payment brings him closer to full ownership. He hasn't had to worry about market volatility or the ups and downs that come with investing. Both men have faced their own version of financial stress. Sam's comes from market swings, while Mark's is tied to having less cash on hand for emergencies. When you look at their choices side by side, it's clear that each path comes with trade-offs. Mark gave up the potential for higher investment returns in exchange for debt, freedom, and certainty. Sam accepted more risk, believing that over time the market would reward him with greater growth and flexibility. Which feeling matters more to you, the calm of a mortgage-free home or the flexibility of accessible cash? Research backs up the importance of both liquidity and debt freedom. A 2021 financial wellness survey found that people with emergency savings report 30% less financial stress than those without. At the same time, studies show that being debt-free brings a sense of satisfaction and security even if your net worth isn't dramatically higher. Mark's relief comes from knowing the house is his and the bills are gone. Sam's confidence comes from having options and the ability to respond quickly to whatever life throws his way. So, what's the right move for you? Should you focus on wiping out your mortgage as fast as possible, invest every spare dollar for long-term growth, or try to find a balance between the two? Think about your own goals, how much risk you're comfortable with, and what kind of financial peace matters most to you. As you weigh your options, consider these questions and how they fit your personal situation. Conclusion: there's no one-size-fits-all answer. Your goals and risk tolerance decide the right path. Some people value the guaranteed peace of mind that comes with being debt-free, while others prioritize growing their wealth and having flexible access to cash. Ask yourself, do I need guaranteed peace of mind? Can I handle market swings? How important is liquidity to me? Taking a few minutes to answer these questions can help you figure out which approach fits your situation best. If you're unsure, talking with a financial advisor can help you map out a plan that matches your needs. Let me know which strategy resonates with you in the comments, and hit subscribe for more deep dives on smart money decisions.